All right, let's jump right in. Today, we're going to break down a really clear investment blueprint for India, looking specifically at the next 2 years. We've pulled together all the expert analysis to give you a straightforward, actionable game plan. So let's get into it. So here's the billion-dollar question, right? India's economy is absolutely on fire. So where do you even start if you're looking to invest over the next couple of years? Let's unpack what the pros are suggesting.
And you know what? We're not going to make you wait for the answer. Here it is, the big picture strategy, right off the bat. It's a 70-15-15 split. A pretty hefty 70% goes into equities. That's your growth engine. The other 30%, that's your defense, split right down the middle between gold and fixed income to act as a shield. Now, let's dig into the logic behind this whole setup. Okay, so before we get into the nitty-gritty of what to buy, we really need to get our heads around the why. Why India? What's the story that makes this such a compelling idea right now? It all starts with the powerhouse economy. And boom, here's the number that stops everyone in their tracks. We're talking about a projected 7.5% GDP growth annually, all the way into 2027. I mean, just think about that. That's not just strong. It's in a different league compared to most other big economies out there. This growth is literally the fuel for this entire investment idea. And this isn't some one-trick pony either. This growth is firing on all cylinders. You've got strong consumer spending, massive, and I mean massive investment in things like infrastructure, plus the whole Make in India push is really gaining steam. And to top it all off, credit is flowing freely. And if that wasn't enough, you've got a helping hand from India's central bank, the RBI. The thinking is, with inflation cooling down, they're likely going to start cutting interest rates. What does that mean for us? Well, it makes money cheaper. Cheaper for businesses to expand, cheaper for people to buy things. It just greases the wheels of the whole economy and gets investors excited. So that powerful economic backdrop leads us directly to the star of the show, the biggest piece of the pie, equities. We're talking 70% of the portfolio here. This is where you're really looking for that growth, the engine that's going to drive the returns. Okay, and this is where you can really see the strategy take shape. You could just buy the whole market, right? The Nifty 50. And that's not bad. You're looking at a solid 8 to 12% a year. But if you get a bit more targeted, if you pick your spots in the right sectors, those potential returns could jump to a seriously impressive 12 to 20%. So the big question is, where are those spots? Well, the analysis homes in on a few really exciting areas. First, you've got tech and IT. I mean, they're riding that global AI wave. Then there's renewables, which is just a massive green energy investment story. Pharma and healthcare, that's a classic play on demographics. And of course, you have infrastructure and financials. These are the companies literally building the new India and financing it. They're direct bets on that domestic growth we talked about. But listen, whenever you have this much excitement, you've got to talk about the risks. And a big one right now is something called valuation froth. It's a fancy term for when things get a little bubbly. You know, when enthusiasm pushes prices for some stocks way, way past what they're fundamentally worth. It's like a party that's gotten a little too wild, and it raises the risk of a pretty sharp hangover or correction. So let's be real about what could go wrong. Some of those smaller, high-flying stocks, they're so hot right now that they could easily see a major drop. We're talking 20, maybe even 40%. Another risk is that company profits just don't live up to the sky-high hopes everyone has. Or, some unexpected global event could come out of nowhere and shake everything up. You have to go into this with your eyes wide open. And that's exactly why we have the other 30% of the portfolio. If equities are your high-powered offense, scoring points, then gold and bonds, well, they're your defense. Their job isn't to be the hero and score big. Their job is to protect your capital when the market starts to play rough. And they're not the same type of defender either. Think of gold as your insurance policy. It's for the big, crazy, unexpected stuff. A war, a currency crisis, you name it. Fixed income, or bonds, that's your stabilizer. It's more predictable, it's there to protect your principal, kick off a steady stream of income, and, this is super important, give you that dry powder, that cash, to go bargain hunting when stocks go on sale. And you don't have to take my word for it. This quote from the research we're looking at just nails it. It says that when stock markets crash, gold tends to go up. And that simple fact can make a huge difference in how much your total portfolio goes down during a crisis. It's a powerful shock absorber. Okay, let's take a breath and recap. We've got the why, that booming economy. We've got our offense, the equities, and we've got our defense, gold and bonds. So now for the really practical part. How do we actually execute this game plan?
Let's bring it all together. And here it is, the whole blueprint laid out. You can see how that 70% in stocks is broken down. You have your solid, stable, large companies as the core, and then you add in some smaller companies and thematic plays for that extra growth potential. Then on the other side, you've got that 10 to 15% in gold and another 10 to 15 in fixed income for that defensive shield. It's a really well thought out, balanced structure. But look, having the right map is one thing. You still have to drive the car correctly. How you implement this is just as crucial. Experts stress a disciplined approach. First, don't just dump all your money in at once. Phase it in over a few months to smooth out your entry price. Second, check in a couple of times a year and rebalance. That just means trimming your winners and adding to your losers to get back to your targets. And finally, be smart about taxes. So what could this actually look like in terms of returns? Well, nobody has a crystal ball, but we can look at the probabilities. The most likely scenario, the base case, is for a return in that 10 to 14% range. But you also have to consider what happens if things go really, really well. That's the bull case. And of course, what if they don't? That's the bear case. The point isn't to guess which one it'll be, but to understand the whole spectrum of possibilities. All right, so let's boil this all down to the crucial takeaways. Number one, that heavy lean towards equities, it's not a wild bet. It's justified by India's incredible growth story. Number two, within your stocks, don't put all your eggs in one basket. Diversify. Number three, think of gold as cheap insurance. And number four, don't forget about bonds. They're your anchor, providing stability and the cash you need to take advantage of downturns. And that really brings us to the big picture. We've just walked through a really clear, data-driven strategy for the next 2 years, a smart balance of offense and defense. But it kind of leaves you with an even bigger question, doesn't it? If this is what the next 2 years look like, what does the rest of the decade hold for India's amazing economic journey?